Predicting how low your portfolio might go in a downturn is one of the most debated and difficult challenges in finance. Traditional methods often lead to guesswork, leaving professionals vulnerable during market stress. Today, I'll show you how PredictDrawdowns provides a scientific, reliable approach to forecast maximum drawdowns and recovery periods so you can stress test with confidence and clarity. In the finance industry, managing downside risk is essential, but it's fraught with complexity. Investment managers and analysts typically rely on historical simulation or complex Monte Carlo models. At quarantadue.ai, every MCP workflow starts from the real tool interface, not from a generic prompt. The goal is simple. Keep the expert in control while the system structures the evidence. Inputs, reasoning, and outputs stay connected in one reviewable flow. Now the results become easier to compare, easier to review, and easier to explain. Historical data doesn't always account for changing market conditions, like shifting volatility regimes or new economic factors. Monte Carlo simulations can be slow, resource-intensive, and require specialized expertise. This creates a gap where professionals struggle to get quick, accurate estimates for stress testing. The real challenge is quantifying potential losses and recovery timelines, especially when markets behave unpredictably. Generic tools fail because they assume past patterns repeat exactly, but markets evolve and correlations break down. So, how does PredictDrawdowns tackle this? It uses a technical method based on regime-switching models and probabilistic forecasting. Instead of treating all historical data as equal, we identify different market regimes, such as high volatility periods like 2008 or low volatility phases, apply statistical techniques to segment history and simulate how your portfolio might behave under similar conditions. Key concepts include maximum drawdown, which measures the largest peak-to-trough loss, and recovery period, estimating the time to bounce back. We also incorporate tail risk metrics for extreme events. A common misconception is that drawdowns are based on simple averages, but that ignores volatility clustering. Our model addresses this with advanced time series analysis and machine learning, adapting to changing market structures for more accurate predictions. Now, let's explore the software solution. PredictDrawdowns is designed for practicality and ease of use. You start by uploading your portfolio data, asset allocations, historical returns, or live feeds. The software ingests this securely and establishes baselines from historical market conditions. It runs thousands of simulations to predict potential drawdowns and recovery periods. You can customize scenarios with stress factors like interest rate hikes, geopolitical tensions, or sector-specific shocks. The system provides a comprehensive audit trail, logging every assumption and calculation, which is crucial for compliance. Scenario modeling allows you to compare what-if analyses, helping you understand the impact of different market environments on your portfolio. Let me walk you through a hypothetical example. Consider a diversified portfolio with 50% U.S. stocks, 30% international bonds, and 20% alternatives. Using PredictDrawdowns, we input historical data from the past 30 years, including bull markets, bear markets, and crises. The software might output that under a stress scenario similar to the 2008 financial crisis, the maximum drawdown could be 30% with a recovery period of 24 months. But if we adjust the volatility assumption to reflect current market conditions, the drawdown might be 20% with a faster recovery. This example shows how you can tweak variables like asset allocation or market volatility to see different outcomes, all based on robust statistical models. For compliance and reporting, PredictDrawdowns generates detailed reports that are thorough and accessible. These reports include charts of predicted drawdowns, recovery timelines, and risk metrics like value at risk. They are formatted to meet regulatory standards, such as those from the SEC or MiFID, and are designed to be easily understood by clients, boards, and regulators. This transparency ensures that your risk management process is defensible and clear. In summary, PredictDrawdowns transforms how you approach downside risk. It provides fast, accurate forecasts without the complexity of traditional models, saving you time and reducing uncertainty. By integrating this tool into your workflow, you can make more informed decisions, protect your portfolios, and communicate risk effectively.